Admission time. We've all been Will. You sit there, staring at your screen, your heart doing tap dancing routines in your chest. You did everything right. You identified the trend, you spotted the support level, you waited for the confirmation candle, and you pulled the trigger. And then, almost as if the market was waiting for you specifically to press that button, bang. A massive, red, violent candle obliterates your account and hunts down your stop loss with terrifying precision. And the second you get stopped out, the market magically reverses and rockets right back in the direction you originally predicted. It makes you want to throw your monitor out the window. It makes you feel paranoid. You start believing there's a secret room of billionaire algorithms staring at a giant screen of your specific $500 trading account, laughing as they steal your money. Well, I have good news and bad news. The bad news is, you're right. You are being hunted. The good news? It's not personal. It's just physics, liquidity physics. You've been taught to look at the market like a playground of patterns, while the elite look at it like a game of pure supply and demand. What you call a perfect technical setup, they call breakfast. Today, we are pulling back the curtain on order blocks, not the watered-down, useless version you see in standard textbooks, but the actual institutional machinery behind them. I'm going to show you exactly how the biggest players in the world manipulate retail psychology to engineer these traps, and more importantly, how you can stop being the bait and start swimming with the sharks. If you open up 95% of trading tutorials or standard textbooks, they define an order block in the simplest, most dangerously lazy way possible. They tell you it's simply the last down close candle before an aggressive upward move, or the last up close candle before a massive drop. They tell you that when price eventually returns to this magical candle, it acts like a superpowered support or resistance zone where institutions left their limit orders, hanging out, waiting to get filled. So, what does retail do? They draw a pretty little box around that candle, place a buy limit order right at the top of it, tuck their stop loss safely right beneath it, and wait. This approach is an absolute illusion. It treats the market like it's a static vending machine. If institutions simply left trillions of dollars of unfilled limit orders sitting out in the open like sitting ducks, the market would cease to function. Let's erase the whiteboard and look at what is actually happening behind the scenes. Think about it like Warren Buffett would. An institution, whether it's a central bank, a massive hedge fund, or an algorithm, doesn't trade with $1,000. They trade with hundreds of millions, sometimes billions, of dollars per position. They face a massive problem that you and I never have to worry about: slippage. If an institution wants to buy 500,000 lots of euro or Bitcoin right now at market price, there simply aren't enough sellers available at that exact price point to fill them. If they just hit the buy button, their own massive order would push the price skyrocketing up, filling their orders at horrible, expensive prices. To buy a massive amount of an asset, they need an equal and opposite massive amount of selling pressure. They need a deep pool of sell orders. And where do millions of retail traders voluntarily place their sell orders? Right underneath obvious support levels, trend lines, and, you guessed it, poorly drawn, obvious retail order blocks. Those stop losses of yours? When you are in a buy trade, your stop loss is a market sell order. So, what does the institution do? They deliberately push the market down, aggressively breaking through support. To the retail trader, it looks like a terrifying breakout. Panic sets in. Retail traders start selling, and their stop losses are triggered as market sell orders. The institution stands right there with their massive bucket open, absorbing every single one of those sell orders at a massive discount. That aggressive, violent footprint where the algorithm manipulated price to collect liquidity before launching the true move? That footprint is the real order block. It's not a cozy support line, it's the scene of a financial crime. We aren't here just to admire how the game is rigged, we're here to play it to our advantage. To trade an order block successfully, you must filter out the noise. We do this by applying 3 non-negotiable laws. Write these down, track them, and do not break them. Never, under any circumstances, hunt for order blocks on a 1-minute or 5-minute chart without knowing where you are on the macro scale. You will find patterns everywhere, and they will almost all fail because they lack institutional weight. First, identify a clear key level on a higher time frame, like the 4-hour or daily chart. Specifically, look for an old swing high or a swing low where retail liquidity is resting. We only care about a lower timeframe order block after price has aggressively stabbed through that higher timeframe level, wiped out everyone's stop losses, and swept that liquidity pool. If there has been no liquidity sweep, there is no high probability order block. Period. Once the market sweeps that liquidity, we drop down to our execution timeframe. typically the 15-minute or 5-minute chart. Now we wait for the reaction. We do not blindly guess. We want to see the institutions show their hand. This appears as a violent, energetic countermove in the opposite direction. It must be a massive candle or series of candles with long bodies and tiny wicks, showcasing absolute displacement. This aggressive move must break above the recent short-term swing high, creating a clean market structure shift. The absolute last bearish candle that occurred right before this explosive, displacing upward run? That candle is your valid order block. The high volume proves that institutional buy orders were finalized right there. Your entry is simple. Set a limit order at the opening price or the 50% equilibrium mark of that specific order block candle. Now let's talk about survival. Your invalidation level, your stop loss, does not go in the middle of the block. It goes cleanly below the lowest wick of the recent liquidity sweep. If price breaks below that low, the institutional thesis is dead, the algorithm has failed, and we exit immediately with a small, calculated loss. Your profit targets are placed at the opposite pool of liquidity, the next unmitigated swing highs where opposing retail stop losses are sitting. This gives you a highly asymmetric risk-to-reward ratio, often 1-to-3 or 1-to-5. You risk $100 to make $300 or $500, letting the math do the heavy lifting. Let's step out of the lab and look at how this unfolds in the real world. This is a real historical structure on a recent major pair. Look at this major swing low right here on our higher time frame. Retail traders have been buying this trend for days, building an incredibly obvious support line. Underneath that line sits a massive ocean of sell-stop orders from thousands of retail accounts. Look at that violence. The retail crowd is in absolute panic. Those who were long are getting stopped out, automatically flooding the market with sell orders. Breakout traders see this massive red candle and eagerly start shorting the market, placing even more sell orders. But watch what happens next. The very next candle completely rejects the downside. There it is. High displacement. A clean market structure shift. The institutions have successfully swept the board, filled their massive buy buckets using retail panics, and reversed the trend. Our order block is locked in. We place our buy limit order exactly at the open of that candle, with our stop loss safely positioned right beneath the absolute low of the sweep. Now we wait for price to retest our zone. This is where the psychological game is won or lost. Price is grinding back down into the block. It looks weak, sluggish, and heavy. Your emotions will scream at you. It's breaking down. It's going to fail just like before. Close the trade early. Retail traders panic and cancel their orders right here. But look closely at the volume. The volume on this retracement is microscopic compared to the explosive move upward. The institutions aren't selling, they are simply letting price drift back to their origin point to mitigate their remaining positions. Boom. Zero hesitation. The moment price hit that institutional liquidity node, the algorithms kicked back in. Will's order got filled, his risk was perfectly protected, and within a fraction of the time it took to drift down, the market expanded violently to clear out the opposing retail shorts resting at the old swing high. That is how you turn market manipulation into your primary competitive edge. Now that I've handed you the keys to this strategy, I need to give you a harsh reality check. A strategy is only as good as the hand that plays it. Order blocks are not a magic wand. They are not an infallible cheat code that will make you rich by next Tuesday. If you go out into the markets tomorrow, over-leverage your account, and take every single random order block you see because you have FOMO, you will blow your account. And frankly, you'll deserve it. In the real world of trading, losing trades are completely normal. They are simply standard data points. Even the most elite institutional setups fail when macroeconomic events or unexpected news injects new volatility into the system. The difference between a retail gambler and a professional trader isn't that the professional never loses. It's that when a professional loses, they lose a tiny, controlled amount of capital. When they win big. Do not look for the holy grail. Look for an edge, manage your risk like a cynical insurance company, and let the law of large numbers play out over hundreds of trades. To truly master this institutional style of trading, identifying the order block is only half the battle. You need to know exactly why price is drawn to these zones like a magnet in the first place, and that comes down to a structural market imbalance known as a fair value gap. If you want to stitch these two concepts together into a complete, high win rate system, you need to understand how institutions use these hidden liquidity voids to time their entries to the exact second. Click right here to unlock the complete blueprint on fair value gaps, and I'll see you over there.